Why do smart investors love the DuPont identity? Because a single equation gives them deep insight into a company. It reveals whether profitability comes from efficiency, financial leverage, or profit margins. Let's break it down. Return on equity, or ROE, is a key metric for investors. It basically tells us how much profit a company generates for every dollar of shareholder equity, showing how effectively management is using investors' money. Now, the DuPont equation dissects return on equity into three parts, giving us a clearer picture. Let's start with the standard formula for return on equity. Return on equity equals net income divided by total equity. Now, here's the clever bit. We're going to multiply this fraction by assets over assets. Since anything divided by itself is just 1, we're not changing the value, just the way it looks. This rearrangement reveals something interesting. These two new components bring us to familiar concepts. Look at this part, net income divided by assets. That's return on assets, or ROA. It tells us how efficiently the company is using its assets to generate profit. And this part, assets divided by total equity, that's the equity multiplier. We've talked about this before. It is directly related to the debt-to-equity ratio and shows how much the company relies on debt versus equity. Let's think about it logically. If a company's total assets are significantly higher than its shareholder equity, that difference has to come from somewhere, right? And that somewhere is usually debt. So we can now say return on equity equals return on assets times equity multiplier. So by doing this simple trick of multiplying by assets over assets, we've broken down return on equity into two really important components, return on assets and the equity multiplier. We can break this down even more. If we multiply by sales over sales, again, just multiplying by 1, we get the full DuPont formula. Return on equity equals net profit margin times asset turnover times equity multiplier. Let's look at each piece and see how they fit together. First up, net profit margin. This is net income divided by sales. It tells us how much profit a company keeps for every dollar of sales. It's a measure of operating efficiency. Are they controlling costs? Are they pricing their products effectively? A higher margin means they're squeezing more profit out of each sale. Next, we have asset turnover. This is sales divided by assets. It tells us how efficiently a company is using its assets to generate sales. It's a measure of asset use efficiency. Are they maximizing the use of their factories, equipment, and inventory? A higher turnover means they're generating more sales with the same amount of assets. Finally, we have the equity multiplier. This is assets divided by equity. It tells us how much of the company's assets are funded by equity versus debt. A higher multiplier means more leverage. When we multiply these three components together, we still get the same value, return on equity. It's like a chain reaction. Profit margin shows how well they make profit from sales. Asset turnover shows how well they make sales from assets. And equity multiplier shows how much of those assets come from equity versus debt. By understanding these three components, we can get a much clearer picture of what's driving a company's return on equity. Is it their strong profit margins, their efficient asset use, or their use of leverage? The DuPont identity lets us pinpoint the strengths and weaknesses of a company's financial performance. It's a valuable tool for investors and analysts alike. If you found this video helpful, stay tuned to better understand the logic of finance.